Welcome to another episode of the Federal Church Presents Better Than Bloomberg. Still covering the global financial collapse 2023, banking system failure of the entire world, much the worst ever. And here you have more of the fat shit class garbage in the background, because again, they don't like addressing reality. And it's these same shit fucks that, along with the dirty little money changers that go around telling themselves that I should be drugged because they can't handle reality or common sense. And now they're getting their comeuppance. Their financial system is collapsing. And within a few short years, they'll be poorer than Mexico. But there have been a lot of good notes that I did not get a chance to cover. Again, because the bastard's been drugging me. They're shit psychotropic fucking bullshit, even though they're the schizophrenic fucking scum of the earth. But here's one from Zerohedge, March 16, 2023. I know we're starting up for the Asian hours right now. What time is it? Yeah, let's get Asian hours right now. Getting ready for the European Open, I mean. But yeah, here's a good one. Bailout bust. European bank default risk rises as Credit Suisse stock tumbles. Now, this is one of the things that I've been watching, but the question I have, I don't know why they're so concerned about Credit Suisse. Credit Suisse was already on the teetering edge. But what was an even worse fucking position are all the pigs banks. All the ones that already saw bail-ins, during the last few years or so. And now they're definitely fucked. So I don't know why that media is still, cheerleading Credit Suisse. Oh, look, Credit Suisse might be this, it might be that, blah, blah, blah. No. It's almost like they're telling you, oh, nothing to see here. Just look over here at this little distraction while, this little, clusterfuck over here is completely imploding. Pretty much the pigs banks, where they have to all be going under. And of course, their share prices are hosed. Their debt prices are hosed. I haven't seen because I can only see what Zerohedge puts up for me. So I haven't seen any of the CDS fucking goddamn prices yet. But sorry, you have to excuse me here. These little shit fucks still keep drugging my food. But it should be a tremendous fucking. Should be a tremendous. What would you call it? Collapse. Or especially that part of the European banking sector. And then, of course, it goes on to the third worlders, wherein it should be even much worse. So, I haven't seen the videos of it yet, but I don't know, maybe because they've already had their, currencies collapse, destroyed already, but I don't know why I'm not watching videos of those people having runs on their banks. But that should be what's happening. And again, they keep talking about Credit Suisse. Yeah, Credit Suisse is one of these SIFIs, these G-SIBs. And it'll be bailed out. Does not, yeah, and I'm sure it'll be fine for Credit Suisse. Maybe not all of Credit Suisse. Maybe parts of the business, parts of the bank. But there's still that toxic debt that should be imploding everything else. Especially the pigs banks. Especially the third worlders. But even that isn't really covering what's going on in Credit Suisse. Here's a note from Zerohedge. Over $50 billion in fresh liquidity to Credit Suisse, and the market is saying more. Despite the Swiss National Bank's bailout, Credit Suisse shares are fading back, and it should be. Given what we know about Credit Suisse, where it's run by shit fucks who should not have been running it, solely based on that fucking, the truth of it is it's affirmative action and its failures. And there was some other problem with its trading where basically they couldn't trade their way out of a fucking paper bag. So I'm gonna guess they're heavily impacted by the dipshit trade there. So it's and even if they weren't, it would have been hedged, and then some other counterparty is going to be paying for it. So the problem's going to be there in any case. But Credit Suisse credit risk is barely improved. Their CDS is, yeah, I mean, it's good out there. So European bank stocks are below yesterday's lows. And like I was saying, especially the PIGS banks, the ones that already had bail-ins and fucking haircuts. You should probably expect those to no longer exist, because if I were the ECB, I would not be propping them up. And again, this is a good time for some cleansing of the zombies in the system there. You know, a lot of these entities shouldn't exist. They're poorly run, poorly managed. They only manage to make it through with cheap, you know, negative interest rate debt. Just like the garbage startups. A lot of these things need to be cleaned up in the banking sector. But as an aside, U.S. regional banks are being sold too. I mean, this is worse than the savings and loan crisis. A lot of those shits should not exist. I mean, that's just the reality of it. I mean, there's no excuse for their fuck up. There's no excuse for it, and it's not even the taxpayer that's going to be bailing them out. It's pretty much everybody, and basically the poorest, dumbest crap in the ready shit. You know, no middle class country is going to be bearing the brunt of it through inflation. And again, there's millions of them that are going to be put in poverty. And more problematically, the credit risk of the European banking sector is soared from the open lows today, and it should, because, as you take a look at this, at all of their books, it should show the failure, just the dipshit trade. And the ECB raised rates. Usually that means they spoke with the Fed. Fed's going to be raising rates too. Maybe not the full 50 basis points, but at least the 25 basis points. Now higher risk than at the peak yesterday before the bailout. And again, simply put, we're going to need a bigger boat. Yeah, that's the thing. You can't bail this out. The bullshit that they're doing. It's okay, so you cover some deposits, you cover the liquidity, but you're not covering the insolvency. It's still insolvent. It's going to keep being insolvent. It's going to get more insolvent over time because of the inflationary environment and the rates environment it's in. And not to mention the geopolitical environment it's in, where these people were dumb enough to get into a war with Russia and China. Even though, you know, it would have full well served their interest to align themselves with it. Or a proxy war at this point. And next note there was... Yeah, this one was from a teacher over there. Cheer, I don't know how to pronounce his name. But time is not our friend. Solvency and Liquidity meet Liquency and Solvidity. I guess we'll say that's it. We're hearing a lot about liquidity and solvency right now. Often people talk about them as though they are two different things. They are two different things, especially this one. Yeah, I disagreed with this note over here. That can be true at times, but in many cases there is a complex relationship between the two. That is particularly true for financial companies and banks, which is where this discussion is centered. Let's start with extreme and obvious examples. Liquidity issue. I borrowed $100 to fund a deal with somebody. It paid me $110 back next week. The person I borrowed from needs their $100 repaid today. I need to borrow from someone for a week to make it through to the $110 payment. That's a liquidity issue. And for some reason the market won't lend it to me. It's a problem. But a simple loan or access to a lending facility from a central bank solves the problem. Liquidity issue solved by liquidity solution. Solvency issue. Borrowed $100 to buy an asset. That asset got destroyed. I have no insurance, so now I have nothing. Just basically those toiletries. I can borrow as much cheap money as possible, but my problem doesn't even begin to go away. Solvency issue is not solved by a liquidity solution. Real world is never so simple. See, this is the case. In this case, it kind of is. I mean, these simpletons really fucked this one up. And, like I said, it wasn't some exotic, derivatives product that nobody fucking knows how to trade, doesn't know what it means, doesn't know what the underlying is, has shit ton of fraud in the underlying too, just like it did in 2008. This is the most plain vanilla securities, and, well, it is that simple, and they should not have fucked it up. Enough liquidity can mitigate solvency issues over time. Absolutely not. Not in this case. Time, in their case, is inflation. Means more worthless dollars. Means their debt becomes worthless in real terms. And there's also the chance that it's going to default too, by the way. But it's that only gets worse over time. They don't have time on their side here. So liquidity over time can help with the solvency issue, but it depends on the strength of the liquidity solution. We'll examine the Swiss solution versus what the U.S. delivered Sunday night. And again, it was not the solution. They just covered deposits. And the bondholders and the shareholders are host. And this was only for 5 banks that failed so far. So that's only 5 banks. You have hundreds more to go. They all screwed it up. It's the entire financial system collapsing. Yeah, are you going to cover all their deposits too? Which ones do you get to pick? Which ones get to survive? The ones you like, the ones you get, cronies in or whatnot, kind of like the SVB with the former Fed something in there as the CEO. I mean, who gets bailed out? Who gets the bail-ins? Who gets the insurance coverage supposedly? But point is, even in the ones they've done already, well, it's not fixed. Nobody in their right mind would keep the money in the bank because it's insolvent. Nobody will do this. And, you covered the deposits. Congratulations. They still have toxic debt that only gets worse over time. We will examine the Swiss solution versus what the U.S. delivered Sunday night. Was it really only 4 days ago? It seems much longer. Yeah, like I said, these coming days and weeks are going to be pretty fucking interesting. That's not good for them. The magnitude of the solvency issue. Balance sheet, or more precisely, equity capital can be rebuilt over time. Not in their case. And there's another note from Zerohedge showing that 80% of all the commercial real estate garbage loans were originated by these regional or smaller banks. So they're holding that garbage plus garbage treasuries. They're not rebuilding their capital. It's not fucking happening. I think the long-term refinancing operations are an interesting example. Basically allowed European banks to buy new assets, government bonds, and secure financing up to the maturity of those bonds after 3 years. Thanks, generating positive carry. Again, that helps support European short-dated sovereign debt at the time. As a new buyer emerged that helped the bank's balance sheets as a whole, there was less fear about sovereigns being able to issue enough debt to cover their maturities. Over time, that small dribble of daily income adds up, shoring up the bank's balance sheet. I don't exactly understand what he's saying here, because when you look at things like the pigs banks, things already teetering on the edge, and, well, I guess a lot of the other ones now too, because I guarantee you the dipshit trade, which is just done by convention, is a problem on their books. Well, that doesn't apply. They were already in a lot of trouble before then. Done with enough oomph up front to help the underlying bond markets, and with enough juice for the banks to gain extra profit over time, this helped a lot. This is definitely threading the needle. beginning there. Liquency and Solvidity. In the U.S., we had Sunday night sessions to deal most directly with Silicon Valley Bank and Signature Bank. The solutions provided were meant to help the entire banking sector, especially regional banks that were feeling the pressure as attention turned from Citi, Silicon Valley Bank, to other banks that some people thought might be vulnerable. We covered some of this on Sunday in I Like Mid-Banks Cannot Lie. It's on Zerohedge, What We Know Post-Intervention, and on Bloomberg TV Monday morning. Yesterday, Credit Suisse dominated headlines, ending the day with the plan announced by the S&P. You'll analyze as well. The analysis tries to balance the solvency and liquidity issues and what the solutions provided so far. U.S. actions so far, I'm sticking to a B+ or a score. They acted boldly and quickly, which is good, but the core problem, unrealized bond losses, hasn't been sufficiently addressed, at least not in my view, where we are in the continuum of solvency and liquidity. Guaranteeing all deposits of any size immediately, that was bold and strong and should solve the bulk of the issue linked to depositors pulling money out, because they are afraid of the risk of keeping it at XYX Bank. Some will still take money out of XYZ Bank because of ongoing concerns with the optics of keeping it there. Some customers are cash flow negative and will see the balances decline for reasons like that. About 90% of the current bank run problem. No, it doesn't, because it's insolvent. Hurting bondholders are prime. Again, bondholders aren't covered at all. Shareholders aren't covered at all. Who the hell would issue debt or buy the debt of the bank that's insolvent? Bondholders were primed in the Silicon Valley Bank and Signature Bank deals. Deposits above the FDIC insured amount, in theory, are unsecured creditors and are pari passu. Bondholders, or the depositors, just got preferential treatment, meaning that if there is not enough value to fully pay off all creditors, bondholders will get less of a recovery. Say there was $100 of deposits above the FDIC amount and $100 of bonds. Say recovery of assets was $180 under the old regime before Sunday. Both the depositors and bondholders would have received $90 as they were equal. Now the depositors are getting $100 and bondholders are getting $80. Again, who the fuck would do that? Subordinating bondholders to ensure the full payment of depositors has been even likely some longer cost. Yeah, again, bondholders hasn't been handled better. Political sound bites, whether it's not bank or bailout or criminal investigation or some other aggressive political soundbite, they're not helping the situation for the banks in question. Political backlash for the rest of us, and makes us wonder about the commitment to the solutions, which is maybe why some will take money out of banks even after the guarantee. The lending at par facilities, it's just fucking ridiculous in and of itself. Borrowing for par versus for underwater bonds. Again, this is the hilarious part. So you're going to do this for every single bank on earth that did the dipshit trade, which only means one thing: inflation. And the poorest, dumbest shit in the country will be paying for it. This is the liquidity solution for the banks. For up to 1 year, banks can post a high-quality bond as collateral and receive a loan based on the par value of the bonds. Let's pour gasoline on the fire. And how did they get there to begin with, right? Let's say a bank owned $100 of a treasury against a $100 deposit they received. That bond is currently at 80 cents on the dollar. The depositor withdrew. The bank had to sell that bond to pay back the depositor. Super simplified, but good enough for what we're trying to illustrate. The bank would only raise $80 by selling the bond. They have to sell the other assets or effectively take money out of equity capital, pay the other 20. There are other issues with bonds unavailable for sale versus held to maturity accounting, but the crux of the matter was the assets earmarked for depositors aren't currently valued high enough to pay back depositors. One good thing is that bonds in question are liquid and are virtually no risk of not getting paid back fully according to their original terms. This is, that's a fucking really, This is the funny part of this all. Because it's not just Silicon Valley Bank that fucked this up. It's probably going to be damn near every bank on earth. And when they're going to be printing trillions of dollars saying, hey, you know what, we'll buy whatever garbage you have at par. Just send it over. Yeah. when you have all of these banks doing all of this, it really does matter if you're the fucking last one to be getting that 2 trillion, probably more than, much more than that in cash, that these shit fucks now have to print to do that. So especially in capital markets. So, I mean, even if it's a short amount of time, it will matter. And that is very different than in 2007 and 2008 when the assets were of dubious and deteriorating. It is of dubious and deteriorating quality. The whole fucking point is that it's worth less with inflation. And now, if you have to fucking goddamn buy a couple trillion of them at par, and some of these people get this money last, well, it's going to be a problem for them. Especially in capital markets. So with the new facility, when the depositor requests $100, the bank doesn't have to sell the bond at a loss. They can pledge it to the facility and receive $100 for that bond, and now, instead of paying interest to the depositor, the bank pays interest to the facility for a year. It helps the liquidity issue. Which in a sense it doesn't, because if you're not getting that cash first, you're still kind of fucked. The bank gets $100 earmarked for a depositor, even though the assets that were earmarked are not kind of worth $100. By pledging the asset as collateral, they don't taint the hold to maturity nature. The whole concept of hold to maturity is idiotic, making the accounting easier. This makes the NIM and solvency issue. As far as I can tell, the cost of using this facility is more expensive than paying the rate paid on deposits. So unlike, say, TRO, this causes larger interest margin losses or reduced capital base. It's using my favorite bonds, the 0.75% treasury maturing 3 years. That was issued on 3/31 this 5 year. But I like this bond because I can see an institution getting deposits in March of 21. Buying a 5-year treasury with those proceeds still seems aggressive to me. But at least I'm not embarrassed. And again, this is more of the stuff too that gives a problem with the run stuff. But at least I'm not embarrassed with that as a scenario, unlike 10-year treasuries, which makes me just wonder why they stopped teaching the S&L crisis if this is going to do. But let's look at this bond. The question that I asked myself, hoping to bolster my case for banks, was if the recent rebound in treasury prices solved the problem on realized losses on bond portfolio. There's no recent rebound in treasury prices. In real terms, they're still garbage. The answer is sadly as a bold no. It has done very little. This bond, which now only has 3 years to maturity, is still worth only 91 cents on the dollar, which is in real terms. Up from recent lows of 89 and well up from the lows of last September when it was only worth 88. I did, out of curiosity, check out the 1.25% treasury of 2/15/31 issued 2021 and is at a 4-day of 81. Lows of 79. I know when talking about unrealized bond losses in September last year, when in all likelihood they were worse. There may have been people writing about it, but it wasn't on my radar screen. Because again, it's psychologically, they're not even going to think about it because they do it by convention. I remember seeing it as a discussion topic. Maybe deposits weren't declining back then, but they were. Just check out the CIVB deposit charge in Saturday's report. There will be time for questioning how this wasn't a problem, then became a problem for another day. In terms of the program, here's what happened. Bank gets $100 for the bond worth 91. Bank pays the 1 year overnight swap rate was 10 basis points. 7%, let's say 4.5 to keep it simple. The bank, assuming this bond is in a not available for sale book and is using accrual accounting, will earn 0.75% income on the bond for earnings purposes for a year. They should be carrying it at book yield, which if they bought it at new issue was 0.75%. The bank will have negative net interest margin of 3.75%, i.e. lose 3.75% on par on this bond over the calendar years in the facility. Far bigger an interest margin than if they were just paying the deposit rate. I haven't seen the deposit rate. They're going to say losing 9% today by selling the bond, but that doesn't help their capital base. So lose it over time. All else being equal, at the end of the year, the bond should be at a higher price, pull to par, or effective going from bit, but between the carry and the likelihood that the bond is still significantly below par from a year from now, I think it's been done for solid service firms. Original 10-year bond, total par 50. Less helping. Program buy some time. Buy time. But does absolutely nothing for the bank's capital. Exactly. If anything, the banks will be worse off having to use its program versus retaining deposits. The bottom line on U.S. intervention, the key to any level of success will be if the banks can retain deposits. Keeping deposits reduces the negative carry versus the facility over time. For par effect helps. The net interest margin losses to the minimum. But even that is only really helpful for portfolios that didn't go way out the maturity spectrum. Over time. Worse. I think it buys the weakest banks time to shore up their capital, possible, when they have longer times. Either through a capital raise or a merger. You're going to put money into a bank that only holds toxic debt. Then these are just depository institutions. They're not fucking investment banks that have different lines of businesses or different assets that are worth something for a merger. And again, here are the indices. If that can occur, then the banks, the next rung up will be fine. As the fire break works, you don't need further protection. Question are, do the weakest banks know they are the weakest banks? That's the thing. Dipshits. The people who end up working there qualified to be doing this sort of thing. Seems obvious, but probably isn't to those in the crosshairs where they accept capital valuations the buyers are willing to pay. That is a bigger concern, and we saw certainly with the ability to squander time, which turned out to be precious in search of a better deal. This isn't Lehman. Because arguably, the underlying Lehman, if you held on to it for the last, what is it now, 15 years, if you held the underlying of what Lehman's garbage toxic debt had for 15 years, you would have the real estate at highly inflated values that they are now. When you hold these garbage toiletries for the next 15 years, you don't have underlying real estate there. You have claims to government debt that they still could default on, by the way. But most likely will fucking inflate away. So this is another point to be made where it is much worse than Lehman. Much worse. Horrendously worse. Because that's how much of dipshits they were. And no, you're not going to be buying any time. Because it's a simple depository institution. And it only has toxic treasuries and toxic fucking ABS. That's all it has. It doesn't have any other businesses. It doesn't have any other revenues. It doesn't have any other assets. That's all it has. So it's not like Lehman. Lehman actually had a lot of other money-making shit. It had other assets that were worth something. This has nothing. This is much worse than Lehman. If those questions get answered correctly, we should be off to the races. If those questions don't get answered correctly, expect more pressure on the weakest banks and have the vortex of weakness to suck more banks into it. Yeah, they're all probably going to be dissolved. The ones who were dipshits, and their failure in managing that stuff. I think we have a few weeks, not months, but weeks before the patience of the markets and reprieve the Fed, FDIC, Bailout Corporation Administration, Treasury Bill bought us starts to fade. It doesn't have weeks. It has days and possibly weeks. This is like what I was saying in Zerohedge, where I wonder where they reached that holy shit moment, where they realized how bad this is, just how bad they fucked up. I'm optimistic that we see capital issues addressed via the private sector, and that paves the way for a rebound, but sooner than later is a key. even for me as an outspoken bull, the European solution, dissolve all these banks. I've run out of time and energy, so we'll be brief here. Addresses liquidity, but not any solvency concerns. They're all insolvent, especially now. Solvency concerns are being downplayed as non-existent, but markets aren't behind. Narrowly focused is a very Swiss-centric solution. Again, they keep talking about the Swiss. They keep talking about Credit Suisse. Now, while it's one of these fucking SIFIs or G-SIFs, yes, it's important. But what's more important is all those other shit banks that are now fucking destroyed. That part is important. I don't know why they're not bringing that up. Swiss National Bank and, of course, UBS is mentioned. And they seem to suggest that reassuring talk is an important part of it. So that's the thing. Is it possible for Credit Suisse to survive this? Or some of their businesses being absorbed by UBS, especially wealth management, because that's what UBS does? Or, I don't know, fucking restaffing their trading side? Yeah. I mean, it's possible for Credit Suisse to remain alive. I think they sold off all their other businesses already. I don't know. It's after Zerohedge to put that up. But, yeah, it's impossible for Credit Suisse or what's left of it to survive. Yeah. Now, all those shit pigs banks? Probably not. And a whole lot of the banks there. With the CS backdrop, the EU went ahead and hiked 50 basis points, highlighting the regional nature of the solution so far. And again, it's because, okay, suppose the ECB, just cut 50 basis points. How's that gonna fucking save them with fucking US Treasuries? You weaken the euro some more? Now you gotta buy dollar fucking treasuries. What the fuck are we gonna do there? Highlighting the regional nature of the solution so far that will likely get tested by markets. No, it's just gonna fucking be resolved. Winners and losers. As soon as discussion starts about good banks and bad banks, about a Swiss bank versus a global bank, the powers that be start picking winners and losers. And that's where it kind of gets fucked up. Where you're going to have hundreds of these fucking banks. And how they go about deciding which ones aren't dissolved, which ones aren't liquidated. That seems to be them. Equity holders, tier 2 capital holders. Yeah, they're hosed. Bond holders are fucking hosed. The closest thing they'll do is maybe some depositors, but that's going to be bail-in city over there. Bail-ins and haircuts, that's all they're getting. Unlikely to fare well and may do worse than whatever natural force plays out. Again, these are all background discussions, but that's uncomfortable. No, this is the worst collapse, the largest collapse so far in history. And we've already gotten to the point where they've already gone to the Fed and been bailed out for more than in the 2008 crisis, which was the last greatest amount. And just like Rickards or stealing my fucking workers over there, yeah, each bailout gets bigger than the last one. And this is much worse than the last one. Magnitude's worse. I give a C- to the Swiss effort so far, as it is too localized. Yeah. You're gonna have shit all over the fucking Eurozone. Especially the pigs banks. Does nothing for capital and starts to hint at intervention in ways that your rights as a certain type of investor might not be given their due course. Well, I give the U.S. a few weeks before markets will... Hours? What is it now? What time is it? It's 2 a.m. over there in New York. So you got 7 hours. 7 hours, 15 minutes. I expect by early next week, which would be today, this was from a few days, this was last week, the luster of the Swiss solution will be gone. Swiss solution is nothing. Congrats, you got one bank. Now what about all the other ones? something more substantive. Time is not our friend. That's absolutely fucking right. The solutions in the U.S. and Europe bought time. How much time is yet to be determined? But only some time, and it is up to various institutions to use that time to fix the problem of capital concerns. I'm optimistic we get good resolution on that front, but that is what is needed. He's absolutely wrong. I don't think he's gotten to that point yet where he realizes how bad that convention